Alright, Cashless Society here again today, bringing you another video on the inevitable world of digital assets, and let's get started. So I wanted to point out this federalregister.gov document that I just saw come through. So it's basically amendments being made to the remittance transfers under the Electronic Fund Transfer Act. So this goes into effect on July 21st of 2020. So in 2 weeks from now, this will be in effect, basically. So why is this important? Basically what, I'm going to read a little bit of the article, but it's 40 pages long, so you definitely need to go check it out on your own if you want to read everything in detail. But the whole point of this is to make, regulations and compliance issues less stringent on the Electronic Fund Transfers Act, specifically on remittances and cross-border payments. Alright, so let's read the summary. The Electronic Fund Transfer Act, as amended by the Dodd-Frank Wall Street Reform and Consumer Protection Act, establishes certain protections for consumers sending international money transfers or remittance transfers. The Bureau of Consumer Financial Protection's Remittance Rule in Regulation E implements these protections. The Bureau is amending Regulation E and the official interpretations of Regulation E to provide tailored exceptions to address compliance challenges that insured institutions may face in certain circumstances upon the expiration of a statutory exception that allows insured institutions to disclose estimates instead of exact amounts to consumers. So that's what the change is basically on. That allows insured institutions to disclose estimates instead of exact amounts to consumers. Alright, the exception expires on July 21st, 2020. In addition, the Bureau is increasing a safe harbor threshold in the rule related to whether a person makes remittance transfers in the normal course of its business. Alright, let's dive a little deeper. So, first, the Bureau is adopting amendments to increase a safe harbor threshold in the rule. Under both EFTA and the rule, the term remittance transfer provider is defined in part to mean any person that provides remittance transfers for a consumer in the normal course of its business. Second, the Bureau is adopting tailored exceptions to the remittance rule to address compliance challenges insured institutions may face in certain circumstances upon the expiration of a statutory exception that allows the insured institutions to disclose estimates to consumers of the exchange rate and covered third-party fees instead of exact amounts. Alright, next up they also state with respect to covered third-party fees, the Bureau is adopting a new permanent exception that will permit insured institutions to estimate covered third-party fees for a remittance transfer to a designated recipient's institution if, among other things, the insured institution made 500 or fewer remittance transfers to that designated recipient's institution in the prior calendar year. Next up, now why is any of this important? Because it really just sounds like a bunch of legal verbiage and everything like that. But really what's going on here is there is an exception within this Electronic Transfers Act that allows institutions to disclose an estimate instead of an exact amount when processing these transfers. And what this really sounds like to me is in Nostro accounts, cash and inventory, fluctuations in exchange rates. Obviously there's issues there. So the development of fintech and financial services has allowed for some changes to this rule, and let's dive a little deeper into that. So it says right here, the Bureau has continued to monitor the remittance transfer market since the publication of this assessment report and observes that most of these developments continue to progress. Examples include the continued growth and expanding functionality of SWIFT's Global Payment Innovation Tracking product, which can increase the amount of upfront information available to sending institutions, and the expansion of major payment card networks' capacity to support cross-border payments. There you go. So It's going to increase the amount of upfront information available to sending institutions. So there's no longer much of a need to estimate. They're going to be more exact because they have more upfront information to guarantee how much money might be sent back and forth. All right, next it says the continued growth of fintech non-bank remittance transfer providers and their further expansion into partnerships and other relationships with banks and credit unions, which allow such entities to tap into the closed network payment systems that non-bank remittance transfer providers have developed. All right, that sounds like Ripple, right? And then they just go on and talk about Ripple right here. 3, the continued growth and expanding partnerships of virtual currency companies such as Ripple, which offer both a payments messaging platform to support cross-border money transfers, as well as a virtual currency, XRP, which can be used to effect settlement of those transfers. All right, so we basically just read that the Bureau of Consumer Financial Protection is making amendments to this Electronic Funds Transfer Act because of the developing world of fintech, basically. And they cited Ripple and XRP. They're not talking about Ethereum. I looked through this entire article here. There's no mention of Ethereum. There's no mention of Bitcoin, anything like that. But that's because XRP, as I've always said, has an actual target market that they're coming after. And as they mentioned right in here, they've continued to expand their partnerships with banks and credit unions, and they also have their own virtual currency. One of the things I always see Bitcoin maximalists knock on XRP about is they say, well, no one's going to use their virtual currency. Why would they use XRP? Everyone just wants to use their messaging platform. So it seems to me like the Bitcoin maximalist argument is that that Ripple has 2 products instead of 1, and that's an issue. When it comes to providing for your clients and your customers, it's better to have more than one option, right? Not everyone might need your XRP, or not everyone might need your messaging platform. It might be, they could use both, or they could use only one. So where's the utility with Bitcoin or Ethereum even in its current state? I just don't see it. But anyway, getting off on a tangent there. The point is that, in this article on the Federal Register website, we got Ripple being mentioned alongside Swift, and this new amendment to the regulation goes into effect on July 21st of this month. So things are coming. We've seen a call in crypto for better regulations and everything like that concerning digital assets. So here you go. It's coming. It's getting rolled out. And if you dig into the cited sources that they have in here, they cite multiple articles with Ripple. Obviously they talk about Ripple and their partnership with MoneyGram, which is really a 10% ownership. Obviously they're doing something there of real value. And then they also cited this article about PNC becoming the first U.S. bank to use RippleNet. So, and as I mentioned before, PNC is owner in BlackRock, which is the largest asset manager in the United States, with I think $7 trillion under management. They basically have their hands in everything. So Ripple is connected in every way, shape, or form to everything finance that's going on in the U.S. as well as around the world. So that's pretty much all I got for you today. As always, thanks for watching. It's not financial advice. I'm not a financial advisor. This is just my passion to help people understand what's really going on around the world, and to try and inform as many people as possible of what they need to get in front of, because this could be life-changing for you. But anyway, thanks for watching. Please like and subscribe, and stay tuned for the next one.